One of the problems with buy and hold investing and why I love trend following strategies is that with buy and hold investing, you have to sit and hold through drawdowns. That can be painful. Like, I don't want to sit and hold my money when the market is going down. Well, fundamentally, that might outperform. I know that statistically, we're not likely to outperform buy and hold investing. That really doesn't work, and that doesn't work for many other investors as well. Like, let's just look at this chart right here. This is the S&P 500 total return index on a monthly basis, represented by the S&P 500 mutual fund by Vanguard, right? And we can see in the early 2000s, there would have been a drawdown over a couple of years of about 35%. And then we would have had the Great Recession of 08, 09, 2010 right there, where you would have had a drawdown a little over 50% in the S&P 500. As an investor, I don't want to be watching my money draw down less than 20% or more than 20% or 10% even. Right now, at the end of January, 20% equities are at about a 10% drawdown. I really don't like it. Going down much further than that, I really don't want to have to experience that. But fortunately, I'm a trend follower, but I'm not going to get into all my strategies here. I'm just going to talk about one specific simple trend following strategy that would avoid these prolonged drawdowns in basically any market that you can apply them to. So let's get into that. Let's think about it here. What if we just said, hey, I'm going to look at the portfolio monthly. I'm going to look at the S&P 500 monthly, and over the last 12 months, if the S&P 500 has had a total return that is higher than cash, so basically zero, if it's positive over the last 12 months, I'm going to go in the S&P 500 for the next month. And then I'm going to look at it again at the end of the month, beginning of the next month. And if it's positive, I stay invested. If it's lower, then I'm going to go out and go to cash. What would that look like? Well, doing that would avoid the drawdowns. Let me show you that on a chart right here over the same time period. Okay, so here is that exact strategy that I just described, going to cash in periods when the total return of the S&P 500 for the last 12 months is negative. Right? When it's positive, we stay exposed to the S&P 500. We can see in this time period, January 1993 to the end of December 2021, so almost 30 years here, the total return would have been 10.76% annually versus the S&P 500. This is just showing equal weight of cash in S&P 500. Let's just put the S&P 500 on there as the benchmark versus the S&P 500 at 10.64%. So it really didn't outperform by a long shot, but what it did is it avoided the drawdown, right? So the drawdown of buy and hold was 50.97%. And the S&P 500 is the yellow line right there. So we can see the drawdown. And we can see strongly right there the difference in 0809. The trend following strategy, simple time series trend following strategy. You might also hear it referred to as time series momentum strategy. Trend following, time series momentum, relative strength. They're all very, very closely, very, very closely related. So right here through 0809, the strategy stays in cash, and then when the market starts going up, it goes on. So what I want to point out here is that trend following strategies aren't really about beating the market. Your aim is to get market-like returns without the downside and volatility. We can see the standard deviation of our model is 11.51 versus 14.61 for the S&P 500, and then the drawdown 50.97 S&P 500. The trend following, in this case, time series momentum strategy, 19.63. So cut the drawdown in half, and you're going to see it in the Sharpe ratio here, 0.75 Sharpe ratio for our model, 0.61 for the S&P 500. So during this time period, right, I would much rather be going to cash when the S&P 500 is not going up, because I'm avoiding those downsides. Now, let's take this a step further here and say, rather than going to cash, what if we could get into an actual appreciating asset? And Treasuries pretty much have the lowest correlation with the S&P 500. I know there's things out there like gold and all that, but statistically, over a longer period of time, it is usually Treasuries that have the most or the least correlation and the most alpha, the most crisis alpha, I guess is what I'm trying to say there. Least correlation and the most crisis alpha. So let's look at 10-year treasuries here. And what we can do is we can say, hey, whatever's going up more, now we're getting into what is essentially relative strength or momentum model, whatever's going up more over the last 12-month period, 10-year Treasuries or S&P 500. I'm going to invest in that for the next month. Let me show you what that looks like here. So over the same time period, our model had a 10.76% annual return and a 19.63% drawdown. If we go to this model, we can see it gained a little. All right, so it went from 10.76 to 11.43%, and then the drawdown I think was 19.43%. This drawdown's a little less at 16.86. Let me put the S&P 500 on here just as a benchmark, and this is the same time period, January 93 to December 2021. And here you go. You can see it. You can see the line isn't so smooth, cash. Now you might be wondering, why is this cash line not smooth here? I believe that the cash number is following inflation, which is why, like, you can see it right there, particularly the value of the portfolio in cash. The blue line is kind of increasing, even though it's theoretically in cash. It's adjusting for inflation. Anyways, here we can see the blue line is, doesn't really go flat ever. It's not holding cash. It's holding 10-year Treasuries when it's not invested in S&P 500, and we can see the performance of that. Now, one thing I want to point out, I guess there's a few things I want to point out here about why things are not as good as they look, right? Like, you're looking at this and you're like, okay, this seems genius. This seems great. Why wouldn't I do that? Well, first and foremost, there are taxes. Okay, so on this portfolio, you can see it has an 11.43% compound annual growth rate. If you take a tax haircut on that, this really goes down, and subsequently your final balance will. Most of your gains are not going to be short-term gains, because if you look at timing periods, we can see a lot of the big returns are in big chunks, right? So there's a 48% return, then things just kind of meander around. You get a 20% return over 29 months, 52% return over 37 months, 23%. Oh, what is this? What are we looking at here? I'm looking at the S&P 500. The momentum portfolio, what we want to look at here in this 17 months, it returned the 48%, 58% in these 37 months. Yeah, all right, so I guess because the only thing it could go into is S&P 500, this column is basically going to be the same. But, in this period here, 95 to 98, 110% in 42 months. So it's holding these things. It's not trading very frequently, and the gains are coming in one big kind of burst of trend or momentum. So it's not all subject to short-term capital gains. But that said, it is going to have a capital gains haircut on it. So the return is going to be a little bit less than 10.76. I mean, I think it would be safe to say that if you were in the highest tax bracket, you would probably want to assume a 20% return haircut. So if we just did that, 10.76 times 0.8, your annual return would be 8.6%. So yeah, there is the tax factor that really plays into this. Whereas buy and hold investing, just because a tax is buy and hold investing is not really going, or is going to basically outperform everything. It doesn't really give off any taxes because it's not trading, it's not selling, it's just buying and it's holding. Which model? We're looking at wrong models here, all kinds of things. Yeah, so anyways, back to the right model. And the other thing that I wanted to point out is that while it does look, it looks like it just keeps going up and it seems like a very robust strategy that's always outperforming. If we change this timeline from just 2010 to 2022, so 12 years, let's put this down here, 2010, put that on the chart, to 2022, we're going to see a totally different picture, right? And that is our momentum model here, 9.73% annual return, drawdown 16.86, whereas the S&P 500 has had a 14.99% annual return and is just absolutely pissing on it. So what I'm pointing out is that while things look good over a long period of time, there's generally market-like returns. In markets like we've just had, in these rip-roaring bull markets for the last 12 years, you're going to be taking a haircut. So fundamentally what you're doing is you're trading a few points of upside return for some downside protection, kind of like insurance, right? You are paying for this downside protection that you get here. So yeah, I mean, I just wanted to make that clear because a lot of people don't point that out. They just kind of look at the big picture trend following. They just go in here and they look at the graph as far back as they can put it. Right, here we go. Oh my gosh, trend following is great. You got to be a trend follower. You're a fool if you're not a trend follower. Look at these returns. Well, there are periods of time where trend following does not outperform and just buy and hold investing outperforms. And in rip-roaring bull markets, that is the time. So yeah, that is a simple trend following strategy. Simply look at the 12-month return of the S&P 500 compared to an asset class like cash or a diversification asset like intermediate term treasuries. You could also use long-term treasuries in there. And just invest based on the 12-month return, whichever one has had a higher return. So that's a wrap on this one, guys. What do you think of this simple trend following strategy? Let me know in the comments below.